Hello you guys. So right now I'm going to give you guys 3 rules of an order block. So what I drew right here is an example of an order block. We're going to go to the charts in a second, but right now this is our example. Rule number 1, when we're looking for an OB and we're actually marking it up within our candles, and we're using 50% of the shorter candle. So this is the first basic rule, that we're using 50% of the smaller candles. Sometimes people use the bigger candles, not correct. It's 50% of the smaller candle. So depending on what your situation is, it's going to be the last up candle before price starts going down, or it's going to be the last down candle before going up, but that can be subjective on your time frame. So the rule is to write down in your notes is 50% of the smallest candle. Okay, so now I want to talk about unhealthy price action, and we're going to make this a buying situation. When you have a buying situation, you do not want any retracement of the wick. So unhealthy price action is pretty much the fact that price is moving in a quick motion. There's no retracement, which is why price has to come back to this point. So I want you guys to look at the smaller candle, and I want you guys to kind of from top to bottom of the smaller candle, look at this as the order block zone. Now in this order block zone, you do not want any wicks coming into this area. So unhealthy price action here would look like this. So these are the wicks of the regular candlesticks. Let's say like this. The smaller candle should have minimal wick, if not any wick at all, like this. So you don't want any future wicks coming into the zone. If you have something like this, you don't have unhealthy price action. It's mitigated. Prices came back here. You might be on the wrong time frame that you don't see it exactly hit at 50%. But you don't want any wicks or retracement into this order block zone. Okay, so it can be right on it. Okay, like that. You might have times where it is like this, and again, it just might be your time frame. So it's a little bit in right here, as you see. But you shouldn't be seeing anything like this. You don't have unhealthy price action. It's not really, an unhealthy area where price has to come back to. Okay, so rule number 2 is that you want unhealthy price action, aka no wicks into your order block zone. And the third rule, which is mentioning to kind of the rule we just set, is that really there should not be much wicks on your order block, and an order block is not a doji. It is not a doji. There's not a doji. It is not a doji. It's not a doji. It's not, this is not an order block, okay? It needs to be a full candle, preferably with the same opening and close, either on one side or both. But you should not have multiple space of wicks showing on both sides and just putting 50% on it. Okay, so we want it to have the same open and close on both, or at least one side. Minimal wick. So this to me is a little bit too much wick. So you shouldn't have more than a third of the candle wick showing. Like this around here be a little bit of wick, a little bit here, but anything like this, you don't really have an order block, and mixed with the other confirmations, you don't really have unhealthy price action. Okay, so we need to represent strong price turnaround within the order block. So let's get on the charts. Okay, so in this example, you guys can clearly see that we have smaller candle and bigger candle 50%, minimal wick, right? So right here we have equal open and close, and then we don't have anything in the zone of the order block. So price does come back in here, which is fine, because it's later on when price is actually trying to come up, and as you guys see, it's going to be a schematic, so I'll show you the schematic. But we have nothing. This does not come back here. Price melts off. Okay, so let me show you guys how this is a schematic. So hopefully we have a point of interest, and when price comes into that point of interest, we're going to look for a schematic. So we have price coming here. This is our highest point, so just making that a distribution, it would look something like this. So if you want to learn, how to do this, you need to start with the basics of understanding structure, understanding points of interest, and then just looking at what price does when it literally gets to the point of interest, right? So if a distro, always want to label top down and then bottom so. I already left the trading range on the bottom. Let's put a trading range on the top. Let's put a trading range on the bottom. So AR. So this would be a second test sitting on the trading range. This one actually closes bodies outside the trading range. So I'll make this a second test. I believe that would be your second test. And our break of structure to our major sign of weakness. Okay, and then we have our entry a little bit on a not much lower time frame. So the entry could actually be considered another order block, but it's also an unbalance on another time frame. So the funny thing about order blocks, it can be an imbalance and an order block. So again, just knowing how to manipulate your time frames. I'm not going to do the restore right now, but you guys know how it goes. Okay, and then there's also an imbalance right here on the 15. So I'll give you guys some of the take profit to see. Okay, so easy stop loss, you know, whether it was a 3.9, and take profit the sow up here, etc. Or even if you gave yourself drawdown, you are good to go either way. The first one's better because your take profit should be at your sign of weakness within the schematic. And this is also your first low as well, and it's a little bit longer than that, so we would have used a smaller one. But that's it, you guys. So hopefully this is a good short cheat sheet on order blocks. Hope you guys got value, and I'll see you guys in the next one.